Stock sectors have lost money. Alan Lancz is our market monitor. He's director of research at LanczGlobal.com. Welcome to Nightly Business Report. Nice to see you again, Alan.
Great, thanks, Tom.
So when we spoke 6 months ago, you were looking to get defensive. Is being protective in the market today still the right strategy?
Yeah, I think so. I think we still got some tough sledding. Half of the gains in the S&P 500 are purely from dividends. So if you didn't abide by our recommendation to get defensive and look at dividend-paying companies, I think you rode the market up 8% and then back down. So it's going to be more of that 2 steps forward, 1 step back.
But there's going to be a difference between being defensive and looking for dividend payers, isn't there?
Oh yeah, definitely. I mean, it's a combination of being defensive, as far as with the sector and your selections. But dividends a big component of that defense, as far as to protect the downside is important in a year like 2011.
In the sell-off we've seen just this month in June, technology and the energy sectors are the 2 worst performing. Technology growth, energy, economically sensitive. What do you make of that?
Well, I think investors got a little ahead of themselves with the economy and thinking that we're out of the woods and we're going to be, moving up and things are back to normal. And that's not going to be the case. We have a lot of headwinds going into the second half of 2011, and including QE2 leaving and what's going on with the European sovereign debt. So when you start looking at that, I think you got that challenge, and investors are starting to realize that, and that's why you got the sell-off.
You mentioned the Greek uncertainty. QE2, quantitative easing 2, the Federal Reserve's bond buying strategy, winds up next week. We didn't hear a lot of confidence from the Federal Reserve this week. We heard patience. Should investors be patient, and if so, what does that mean for a holding period?
Well, yeah, you have to look at it 1-2 years minimum. So from a patient standpoint, I think if you're investing now, there's downside. This reminds me a lot like last summer. When we talked after the flash crash,
right,
where the confidence was shaken, and there were good buys throughout the summer, and then QE2 came, and then we had the rally since August. And I think it's going to be similar. So taking advantage of the weakness, but being patient because you don't know where the bottom is. 2
of your new stock picks have shown considerable weakness as of late. AIG, American International Group, one of those companies that's still owned considerably by Uncle Sam. We know the federal government will be selling its shares. You're a buyer of AIG. Why?
Well, we like it. It's been cut in half. It wasn't over 60 now, in the 28, 29 area. We think the value, stated book value, will be about 37, north of 37. So again, buying on weakness. It's a situation where I think they have more globally than what investors expect. And I like those low expectation type companies.
How about General Motors here, trading below its IPO price? And again, one that is now out from under Uncle Sam. What do you expect from GM?
Well, we recommended selling it after its IPO when it was trading in the high 30s.
But you're a buyer now.
Now we like it. I think the timing's good, under 30. So again, low expectations. You lost 10 points on evaluation, and I think long term again, there's going to be good reward. No dividends prior to, as opposed to our other recommendations.
Right.
But I think good upside potential over the long term.
One dividend stock you do like is Telephone Data Services, better known for its U.S. cellular wireless division. Has been a choppy stock. Telecoms haven't provided a great amount of defensiveness for portfolios. A small yield on this one. What do you expect?
Well, they've increased their dividend 37 years in a row, Tom, and so I like that increasing dividend, and $37 book again, trading around 30 or less. I think it's hard to build a scenario where you don't make money in that over the long term.
Okay, let's take a look at your previous picks when you were here back in December of last year. You liked 4 stocks, a couple of them big dividend payers. Pfizer up 20%, nice big rally there, congratulations. Merck, however, has been down by 2%. Hologic, HOLX up 12%, and Exelon, the energy giant, 5%. Do you still like these?
Yeah, I like them all. We've taken profits in a couple of them partially.
Which ones?
As the market's moved up. I saw a little bit of Exelon and a little bit of Pfizer,
okay,
but still own all 4 and still like them. Wouldn't buy them at these levels, but on weakness, we still like them.
You own the 7 stocks mentioned tonight?
Yes, own them, and family owns and clients own them.
Alan, good luck. We'll catch up in 6 months.
Sounds real good, Tom.
Our market monitor this Friday, it's Alan Lancz.